Real estate agents need to have 3 good loan officers on speed dial, not so that they can give 3 names to each client, but so that they can match clients with the right lender for their specific needs. Giving home buyers names of 3 different vendors makes no sense. There is no rule saying that you have to do this. Connect them with whoever makes sense for their transaction. But how do you know which lender is right for your buyer client? And how do you assemble a trio of lenders to cover every scenario? I'm going to show you exactly how to do this by explaining the 4 types of lenders and reviewing pros and cons of each. Look, this is the world according to Justin, and I will be making generalizations. There will always be exceptions to what I am saying. Each lender type serves a legitimate purpose, and none are necessarily better or worse than the others, but it is important to understand who does what. At the end of the day, good loan officers will provide a good experience, and bad loan officers won't. For the purpose of this video, I am going to separate mortgage companies into 4 categories: independent mortgage banks, or IMBs, depository banks and credit unions, builders, and mortgage brokers. Every real estate agent should have a go-to loan officer with an IMB, a bank, and a mortgage broker. That is where I came up with that magic number of 3. You will work with in-house builder lenders occasionally, but these are going to be transactional relationships and not partnerships. If a lender is renting desk space inside of a real estate office, they are probably an IMB. If a real estate firm has a preferred lender, they are probably an IMB. If a lender has a substantial budget for marketing service agreements, they are probably an IMB. Independent mortgage banks spend a lot of time and money ensuring that they remain in front of realtors and top of mind. They do a really good job of this. Realtors love them because of easy access and willingness to spend money on co-marketing. IMBs are also logical choices to be a preferred lender for tract builders who do not have their own in-house financing company. This is because IMBs tend to have teams of loan officers, loan partners, loan officer assistants, and processors. They operate under an assembly line model and therefore have the capacity to handle a large amount of volume. Large marketing budgets and teams are great, but these features cost money. For this reason, rates and fees tend to be higher than what consumers can find elsewhere, and this has a real impact on buying power for some, especially buyers using FHA or VA financing. Also, if their underwriter turns a file down, it is a done deal. They have limited options for moving the file elsewhere. Finally, while teams allow for smooth operations internally, borrowers may be interacting with multiple people throughout the process. Banks are depository institutions that benefit from not being reliant on a warehouse line of credit to loan money. They can keep loans in their portfolio and not have to worry about selling these loans on the secondary market. Therefore, they are able to offer specialty loans that greatly benefit certain clients. Banks are really great at offering jumbo loans. They excel at construction loans and are a wonderful partner for local and regional builders. Since they are lending their own money, banks are able to offer competitive adjustable rate options, unlike IMBs and mortgage brokers. Banks target deposit accounts. They want people to open up savings accounts, CDs, etc. Banks love high net worth clients, and that is why they are able to offer special mortgages for doctors. They are also subject to the Community Reinvestment Act, which incentivizes them to offer special home financing terms for buyers located in underserved areas. Keep in mind that banks have multiple sources of revenue, and mortgage lending is only a small part of their operation. It is not necessarily the main focus of bank executives. They may have more restrictive underwriting guidelines and overlays, especially on agency lending. For this reason, an IMB or mortgage broker may be a better option for fixed rate Fannie Mae, Freddie Mac, FHA, VA, and USDA products. Banks do not always prioritize operational staffing in their mortgage divisions. Think disclosure team, underwriters, and closers. Understaffed operations tends to increase the amount of time it takes to receive loan approval or have closing documents drawn up. This all impacts how quickly a home purchase can close. Most home builders have their preferred lenders, which are typically local IMBs or banks. However, some large builders operate their own financing arms. They want to have full autonomy of the entire process and will often provide huge incentives to entice buyers to use their mortgage company. Incentives can include large credits towards closing costs, temporary rate buydowns, or free upgrades to the home itself. Of course, I use the word free loosely because the cost of all these benefits are baked into the price of the home. For this reason, other lenders cannot compete with these offers, and it makes sense for buyers to use the in-house lender. That doesn't mean that a buyer can't refinance elsewhere shortly after closing on their new construction home. Also, since it typically takes 8 to 12 months or maybe more to build a house, it is imperative that builder lenders are able to offer long-term rate locks. That is something that they tend to do well. It is not uncommon for home builders to be punitive towards buyers who use outside financing. One example of this is a common clause in their contracts that impose daily penalties for delays in closing, regardless of the reason, when an outside lender is used. Even if the delay is waiting for a final inspection or reviewing a certificate of occupancy that was just issued. This is where close coordination between the lender and builder comes into play. Builders typically have a lot of houses going up at the same time, therefore you may not be a priority to them or their lender. Since loan officers working for builders do not source their own business, they get paid significantly less than others within the industry. This results in a tendency for builder LOs to be less experienced and knowledgeable than others. In other words, box checkers and order takers, not advisors. Realtors and home buyers, you may have to suck it up and deal with builder lenders on new construction homes in some cases, and that is okay. Just be aware that it will be a transactional relationship. Mortgage brokers operate in the wholesale channel, while the other three types of lenders that I've discussed all operate in the retail channel. In a nutshell, this means that while brokers are partnered with the lenders they send loans to, they are also independent. Brokers typically have a lineup of different lenders that they can send files to. They get wholesale pricing from these lenders. This means that consumers can get lower rates by working with a mortgage broker because brokers defray a lot of lender expenses in originating loans without having to pass that on to the borrower. That is all to say that a major benefit to working with brokers is lower rates and fees, which ultimately leads to more buying power. At a minimum, any borrower using a government loan should definitely get a quote from a broker. Brokers also tend to have the most experience and be the best loan technicians within the industry. That is because brokers tend to have their hand in every step of the process, from disclosures to processing to closing. Most broker shops are small, so they do not have large teams, but are flexible and can make things happen quickly. Since they have access to multiple lenders, brokers can offer a wide variety of loan programs with minimal overlays. These wholesale lenders tend to have enough capacity in their operations to close loans very quickly, so that is another plus. Since a lot of mortgage brokers handle the entire process themselves, there is a limit to the number of loans they can handle simultaneously without having to hire assistants or processors. This means that a small broker shop may not be a good partner for home builders. Also, if adjustable rate options are important to a client, then they will probably be best served to work outside of the broker channel. Finally, brokers tend to have smaller marketing budgets, so if you are a realtor seeking big marketing service agreements, then a broker may not be the best fit for you. Each type of lender has a place in our mortgage ecosystem.
Each of us is a flower growing in life's garden.
As I was saying, nobody is better or worse than the next. Everybody excels in some areas and not others. Realtors, I hope this video has helped your understanding of who does what and will provide guidance for making future referrals. As a loan officer, I often refer clients to insurance agencies. This is a good example of why having 2 or 3 vendors at my disposal is important. There are certain insurance companies that specialize in new construction homes. I know which ones will do better with older homes. I know exactly who to call if there is a concern with polybutylene piping. Having a few agents on standby allows for me to provide the best recommendations for my clients based on characteristics of the home. I analyzed over $2.2 billion worth of mortgage transactions in the Cape Fear region from the 200 top producers in our area. Here's what I found. About half of the transactions were done by independent mortgage banks. A quarter were handled through banks and credit unions. 15% were through builder lenders, and just under 10% were originated by mortgage brokers. This covers New Hanover, Brunswick, and Pender counties. Mortgage brokers closing 9.9% of transactions is way lower than the 25% market share nationally. I'm not quite sure what to make of this. My knee-jerk reaction is to speculate that there are simply fewer brokers in Wilmington than other parts of the state and country. Maybe brokers have done a bad job of marketing themselves. I don't really know, but it is something that I'm going to investigate, and I'll keep you posted.